Hi everyone, welcome to this month's Financial Markets Update. Well, July proved to be another solid month for financial markets. We saw some very strong investment performance across all the major asset classes over the course of the month. This is led by emerging markets and global small to mid caps, which were up around about 4.5% to 5% throughout July. But equally, listed REITs were stronger. Aussie REITs led the way, but we did see some solid investment returns out of global REITs as well. And bond markets were by and large slightly higher as well over the course of the month. Global bonds were flat, but we did see some positive investment performance out of the domestic bond market. And we think about the return profile over the last couple of months. It really, in our view, has a lot to do with what we're seeing in regards to central bank policy. Both the US Federal Reserve as well as the RBA were on hold over the course of the month of July. We did see the ECB and the Bank of England increase cash rates in their local jurisdictions. But broadly speaking, central banks are now taking a more nuanced approach to the raising of cash rates. And from a US perspective, we're now starting to see real yields move back into positive territory. So on an inflation-adjusted basis, we're now seeing, as I said, cash rates become positive again. And in our view, that really is a watershed moment in the way that the US Fed is likely to adjust the cash rate going forward. Inflationary expectations are moderating and moderated quite quickly throughout the course of 2023 in the US. We haven't seen the same level of decline here domestically, but we've certainly started to see a moderating inflationary outlook here. Notwithstanding that, as I said, we're likely to see one further rate rise in the US, and then we believe that will see the top of the rate cycle, particularly if those inflationary expectations continue to move lower and real yields push higher. So that will provide that flexibility for the US Federal Reserve. In our view, that'll be positive for financial markets throughout the second half of this year into 2024, and equally allow the US Federal Reserve to think about cutting rates at some stage in 2024. We don't expect any rate cuts throughout the course of this calendar year. From a domestic perspective, real yields aren't anywhere near positive territory yet. But when we think about it in the context of the rate cycle program, just given the slowdown that we've seen in personal consumption throughout the first half of this year, as well as the fact that we're likely to see a further increase in a shift of mortgages from fixed to variable rates, we think that that's going to lead to an ongoing slowdown in the domestic economy. And certainly from an inflationary perspective, we think that that will also start to moderate throughout the second half of this year. So that catch up may be quicker than what we've seen to date. Notwithstanding that, as I said, we expect one further rate rise here domestically. But we don't see that occurring until probably the fourth quarter, so most likely October, when the RBA will be able to get the next full quarter-on-quarter CPI print to the end of September. And we think the RBA therefore will be on hold throughout the months of August and September, just given that likelihood of a further slowdown here domestically. In terms of sort of a recessionary environment, our main view is that with labour markets remaining strong, unemployment at roughly 3.5% here, both domestically and as well as in the US. From our perspective, we expect that strong labour markets are going to lead to an avoidance of any significant recession here or in a global context. And we think that, again, that'll be positive for financial markets to be able to sort of muddle through over the next 3 to 6 months. The labour market's really quite critical in that context from our perspective. On the negative side of things, certainly the slowdown that we're seeing in China is starting to become more of a challenge, and we really are now looking at a deflationary environment in China. Both broader CPI as well as input good costs have declined materially over the last sort of 3 to 6 months, and that's certainly something that, in our view, is likely to put pressure on the Chinese economy. And again, we've seen that with both input and export and import trade also decline materially over the last couple of months. So again, the pressure there in terms of the growth outlook, we think will result in further policy stimulus, both in terms of the weakening of the renminbi, that has obviously depreciated somewhat throughout the course of 2023, but we think that's probably likely to push lower through the second half of this year, but also the flexibility that the PBOC has in terms of cash rates, which are materially higher relative to the rest of the world. So we're certainly expecting, as I said, further moves in the RRR ratio throughout the course of 2023. And then you've got the government to be able to provide, targeted policy stimulus, which we expect to occur as well throughout the second half of this year. So, certainly some challenges on the horizon, but as I said, they can be addressed in our view, and we're not expecting to see a significant or material recessionary environment at all in a broader global context, either domestically and or on from the US perspective as well. And finally, just on that side of things, we've just come out of the US and European reporting seasons. We're heading into the reporting season here locally. You can see here from these charts that certainly in terms of analyst expectations and market expectations, the earnings season in the US was reasonably sound. With all sectors really delivering, above the line earnings surprises. Notwithstanding that, we did see the overall growth outlook moderate across certain sectors, certainly the more cyclical parts of the market, energy and materials, as an example. The earnings growth obviously moved back into negative territory. That's not to be unexpected from our perspective, given obviously the slowdown that we've started to see more broadly, and particularly, as I said, the ongoing slowdown that we've seen in China. However, overall, as I said, July proved to be another solid month for financial markets. It's clearly not going to be a month-on-month expectations that we like to see these types of returns, but I think it does highlight the fact that financial markets are really trying to look through the rate cycle. They are trying to take a view that central banks are obviously closer to peak rates, and ultimately throughout the second half of this year into 2024, we may, as I said, likely to see rates actually decline as inflationary expectations moderate further. As always, if you have any queries about your portfolios, please feel free to reach out to anyone on the team, and we'll catch up again next month. Thanks, and bye for now.